Tax recognition is the decision about when you're going to pay taxes on money that you are saving or investing. You're given some choices in the world that we live in today, whether that be a tax-deferred investment account or whether that be a Roth IRA or perhaps even a Roth 401k. So what do? Do you defer the taxes and pay the taxes later on that and the growth? Or do you recognize the taxes today and make it free in the future? We're going to answer that for you on Consider This Program today. Well, good morning and welcome to Consider This Program. I am your host, Joe Clark.
And I'm Daren Hardesty.
Happy to have you along, Daren. And for all of you that are joining us, so we're going to talk about one of the most perplexing things and one of the most complex choices that people have to make. And it's that, you know, the bird in the hand is worth more than the bush, or how's that go?
I have no idea.
Yeah, I think it's an expression that kind of died with my childhood. But anyhow, the point is, when you have money that you can put into an account, let's say you have a 401k, right? And it offers you the ability to do tax deferral. So you can put money into the plan and pay the taxes on that plan, or pay the taxes on, not pay the taxes on that income. You can defer it and then wait for a later time. And you can pull the money out at a later time, and then you're going to pay the taxes not only on the contribution, but also on the money. Right? That's tax deferral. Now, tax recognition, on the other hand, is when you're able to use the Roth option. And the Roth option says, tax me today, right? Tax me today. And then you never have to pay, nor do your heirs have to pay the taxes on the amount of the contribution or the growth. So, Daren, which should I do?
Well, that depends on your situation.
Okay.
Depends on your income, depends on a lot of things, but the vast majority of people, we always say, take the free money first. So if you have a 401k plan of some kind with a match and the company wants to match a certain percentage of that contribution, there's nothing better than free money. So even if it's if you only have a tax deferred option inside the 401k, take that first. The second thing we would say is to look into a Roth to be taxed today. And
so now you're talking about a Roth IRA.
Roth IRA, or if you can, it's kind of confusing because a Roth 401k, it's very similar. You recognize the taxes when the money goes in, but the contribution rules are different. It's inside of a 401k plan versus an IRA. But yes, we would say put into the Roth IRA. For most people, that's going to be their
What's the
option.
biggest difference between a Roth IRA and a Roth 401k?
Contribution limits.
Contribution limits, and what other limit?
You're going to have to help me there.
Income limit.
Yes.
Right?
Yes.
So if your income's too high, you may not be eligible to do a Roth IRA.
Correct.
You can still, there is no income restriction on a Roth 401k.
Right.
The two amounts aren't combined.
Correct.
Right. So a lot of times people say, well, I can't do a Roth 401k because I did a Roth IRA.
Yeah.
Those are two different stories, right? Two different stories.
Right. Absolutely. So
what is really the thought process? When I'm sitting down here, right, there's two big ones, right? So I'm sitting here, I'm Joe Clark, I'm 54 years old, and I'm trying to decide whether I put money in the Roth 401k or whether or not I put money in the tax-deferred part of the 401k. What are the two things that I'm thinking about?
Well, you're thinking, what is my income going to be in retirement? And I think a lot of people assume that they're going to make less in retirement. Their taxable income is going to be less in retirement.
What do you think they believe that? Because you believed it when you came to the firm.
Right.
You now know that's hogwash.
Yeah.
But why do you think why do they believe that?
I think they just assume that they're going to live. I mean, the industry says you should only have 70% of your income, and that should be enough for your retirement.
The academics say that, not the industry.
Right. So I think a lot of people just think, well, when I retire, I'm not going to be spending as much. I'm not going to need as much, and therefore I'm not going to have as much income coming in. But what they don't understand is that they don't really have a lot of say over what the income is that comes in. With Social Security, they may have, depending on their age and their profession, they may have some kind of a pension. Those things automatically get thrown into their taxable income, or at least a percentage of it. And then when you turn 72, if you're not taking money out of the IRA, you're going to be forced to take this large amount. So, let's say you retire at 62. You have $1 million in your 401k. You don't need it. You're not using it. You take Social Security. You're doing just fine. You get to 72, and all of a sudden, now your 401k account or your IRA account's close to doubled, and the IRS comes in and says, hey, we have to start taxing these dollars. And you might be forced, just like you talked about, we have an 86-year-old family that he's forced to take out way more money than he ever would need. Therefore, he gets thrown into a higher tax bracket.
More money than he ever made.
Right.
right?
Yeah.
So one thought process about whether or not I recognize it today is, do I believe that my income will be more or less in the future?
Correct.
Right? What's the second one?
I guess it would be dependent on, how you're gonna have to help me here.
What I believe tax rates are going to be in the future.
Sure, absolutely.
Right?
Yep.
So a federal judge actually ruled that it is illegal. This was probably 10 years ago. It's illegal for me to tell you that tax rates are going to go up. So I won't tell you that tax rates are going to go up.
Right.
I can tell you I feel like they're going to go up, but I can't tell you, with any assurance of that at all. But when I make the decision to contribute to the Roth portion, now keep in mind, the money that I have to put in as the quote unquote employer, because I'm the managing partner at the Financial Enhancement Group, that money has to be tax deferred. I have no choice, right? But the other money, I get to decide whether I want to put it in that Roth part or not. There is no income requirement, right? So nobody can say, well, you make too much money, so you can't contribute. Anybody can put it in if they want to. And I have to make the decision, do I believe today's tax rates are higher or lower than where we will be in the future? Right? Mm-hmm. And then the third thing that you have to ask, and I think this is where, and in fact, I wrote the article for the Herald Bulletin. You can find that on our website. It's called Tax Recognition. But when I wrote that article, I think the thing that people miss, perhaps as much as anything, is inflation. Right? So when you go to retire, Daren, you do not have to replace your income. These things that are out there that tell you that you need a certain percentage of your income and or any of that, that's all hogwash, right? That what you need is 100% of your standard of living. So if you're a good earner and a good saver and you're making $100,000 a year, but you're only spending $40,000 a year, it's real easy in your mind to say, well, I only need 40 when I retire. Thus, I'm going to do tax deferral because I believe my tax bracket is higher today than it will be in the future. Right? What people fail to factor in, they fail to factor in the fact that you have this tax rate that is a risk because the tax rate can go up or it could go down. I'll stay with the judge on that one. Mm-hmm. Right? Could go up, could go down. Got my opinion, you got yours. But inflation will be there. Right? Over a 25-year period of time, you may have only needed $40,000 before, but suddenly now you need $110,000 to be able to buy the same things that you needed before.
Right.
And you've now pushed yourself into a higher tax bracket. Even if the tax rates stay where they are, you've pushed yourself into a higher marginal rate. And I really think there's some things that people need to consider before they simply say, I'm going to defer the taxes right now.
Right.
And it's, it scares me, some of the mistakes that I see people make.
Yeah. And, I have friends that have good incomes and they're able to, and they're great savers. They'll make the max contribution to their 401k. And they have the ability to do that. And it's great. But a lot of them have never heard of what a Roth is. You tell them about a Roth account, and many of them think that Roth must be some special type of investment and don't understand it's all tax code. It's all just how the money's taxed when it goes in. And encouraging them, as you've said many times, there's three buckets if you can diversify how you invest so that you can control your taxation in retirement. I think that's really an important concept of saying, all right, I've got the Roth option, I've got my 401k or my pre-tax option, and I've got my brokerage account option. And being able to kind of spread out your investments in those three buckets in an almost equal way as much as you can so that when you get to retirement, whatever money you need, high income, low income, doesn't matter, you can control that taxation because you've taken those steps along the way. Most people, though, they choose pre-tax and they don't realize what's happening until one day they're paying more in taxes than they ever could imagine.
It feels good, right? I mean, you're walking through the line at MCL, right?
Oh, yeah.
And you got chocolate cake and broccoli, right? Mm-hmm. Now, we all know the broccoli is probably better for us in the long run.
Absolutely.
We also know the majority of people are picking up the chocolate cake because it feels good today, right? There are none of you listening to the show today that say, hey, Joe, I want to pay more taxes today, right? I will tell you, I put the money in the Roth side in my account, and my CPA looks at me every year and goes, do you know how much tax money you could have saved? And it's kind of like, yeah. Here's part of my logic. The IRS does not differentiate between the amount you can contribute to a Roth plan versus a tax-deferred plan, right? So let's say I'm able to put $20,000 a year in. I'm over 50, so it's a little bit more. But I put $20,000 into the tax deferred plan. I'm going to have to pay taxes on that money and on all of the growth later on. By definition, my retirement will be diminished by whatever the future tax rate happens to be. On the other hand, when I put it inside of the Roth component, right, that taxes are already paid. I still get to put the 20 grand in.
Yeah.
So it's 20 grand and I've already paid the taxes. And, CPAs, and I love them dearly, and we work with some really, really smart ones, but, I love them dearly. But they will look at you and say, Joe, it makes no difference whether you use tax deferred or Roth, the way the math works. And I said, that only is accurate if you live in a vacuum. It presumes that Barb and I are both alive today and that Barb and I are both alive at the point of distribution, right? So we're married filing jointly. It presumes that tax rates haven't changed, right? It presumes a whole litany of different things. And, you can run all the Excel spreadsheets that you want. You're always going to be better to have diversification in your portfolio because, quite frankly, we don't know what the future holds, right? And I'm not just talking about investment returns. If I told you to put all of your money in one company stock, you would look at me like you're a ding dong, right? I'm telling you, the same is true if you look at it from a tax standpoint. If you do not begin to build that tax diversification, you will come to a point in time in your life where you're going to have regrets. And we help reduce financial regrets. That's what Daren and I do. That's what we do at the Financial Enhancement Group. So when we sit down with you guys in a next steps meeting, here's the deal. We're going to help you establish a financial vision. And we're going to go through 5 critical elements. And Daren, one of the things that I like to steal from James Clear, author of Atomic Habits, and one of the things that he said is that success is never dependent upon one thing, but failure can be. Right? So there's 5 things that I think you can fail and wreck the whole ship. There's other 5 things that we've got to get right to be able to be together. Your life after work, making sure that retirement plan is on track. The annual tax planning, that does not mean tax reporting. The investment playbook, how do we deal with risk and volatility? Life happens. There's going to be things that pop up. And then last but not least is a legacy plan. If I'm gone, how do I get it to the next generation? But more importantly, if I'm still here and can't do it on my own, who's going to take care of it? Give us a call, 800-928-4001.